Hi, everyone. Welcome to Screw the Stock Market. Today's episode is with a special repeat guest, Chris Miles. This is the second time he'll be visiting us on the show. He was recently with us and we went through his basic introduction of kind of where he came from and how he got to where he currently is in life and having attained financial freedom, two separate occasions, a pretty unique one about getting knocked down and getting back up. But we invited him to get back to get back with us and come on the show again because in that story, which we found inspirational and motivational, just because of time, we had to cover it all at a pretty high level. And this episode is pretty special because he gets really a little bit more into the weeds on specific tactics, strategies, asset classes, and tools that he uses and he teaches others to use in terms of how to attain financial freedom in a much shorter time frame. So this one is much more, you might want to pull out your notebook and actually take some notes on this one. Without any further ado, we hope you enjoy episode 2 of Chris Miles on Screw the Stock Market. Thank you again for tuning in, and we hope you get a lot of value from this one. Thank you. Hey there, thank you so much for tuning into the show. It means so much to me and Aziz that you are actually listening, that there's people really listening to the show. We're having fun with it, and we hope that you're getting a lot of value too. Education is just one of the first steps that anyone should take when they're on a journey towards financial freedom or personal development. And so it's great, you're doing the right things. I want to suggest a second step that you might want to consider if a lot of the things that we're talking about on the show are resonating with you. Consider visiting our website, legatoinvest.com/invest. And there's a button where you can click to gain access to our opportunities. And what will happen is you'll schedule a call with us. We'll talk, we'll get on a Zoom, and we'll get to know your investment experience. We'll get to know you. We'll learn about your objectives. And then if it's a good fit, we'll actually start to present you with real investment opportunities from time to time. And you'll be in the driver's seat where you can say, no, I don't like that one. And yes, I do like that one. And those real decisions, that means that you're actually in the game towards your financial freedom. So consider visiting legatoinvest.com/invest. Again, that's LEGADO invest.com/invest. Today, we're really excited to welcome back for the second time, Chris Miles. Chris, thank you for coming back. We're really excited.
Man, just the fact you say screw the stock market just makes me excited to come back more and more. I just can't say enough about it.
Well, you're always welcome.
Yeah, and I think we've had good guests on the show. We're so happy with many of the guests that we've had. But you're the first one that really took us up on the invitation to come back. And we're excited because I felt like last time, we talked about your personal story. We talked about kind of your different ways that you were able to get up off the ground and build and achieve financial freedom twice, which is remarkable. Most people, once you achieve it, I guess the idea is that you don't need to achieve it again, right?
That's what smart people do, right? They just achieve it once, never have to screw up and do it again.
Well, again, it's more lessons, more value for us and our audience to be able to see that it's doable, right? Mm-hmm. Yeah. And it's inspirational. In fact, just a minute ago, I got off the phone with a friend who's a listener, and he said he was really inspired by your story. And so we are thrilled to have you back. And I think the intent this time, we want you to feel free to take the lead and guide us wherever you'd like to go. But I think the intent was just to go a little bit deeper into specifically how to achieve financial freedom. Last time, I think we might have focused more on mindset and the mental shifts that need to happen. Mm-hmm. And then there's still a bunch of tangible, I guess, nitty gritty stuff. So,
and I would add, just for any new listeners who didn't catch the last episode, if you can just kind of briefly introduce yourself real quick for the listeners out there who didn't catch the previous interview.
Definitely. Yeah. Thank you, Aziz. I was going to do that a little bit because, if you haven't watched the first episode, please watch it because it will help a lot. But in short, my story is that I'm a recovering financial advisor, right? I started out 21 years ago as a financial advisor, did that for several years. And then after meeting with my dad and realizing that although he did everything exactly right, he had done He'd done everything Dave Ramsey would have taught you, or everything that my dad taught Dave Ramsey, even if we go that far. I mean, he did all those things right, was debt-free, saved up all his money in his 401ks, yet he didn't have enough to retire even in his 60s until he was forced into retirement in his 70s, if you were to follow up on that. And so when I realized that it wasn't helping anyone become financially free, I had to leave. My integrity was on the line. I couldn't just sell something that I don't believe in. And the common theme of my life is following my integrity, right? Like always practicing what I preach. That even includes our conversation for today, where we talked about me becoming financially independent twice. I became financially independent after I quit being a financial advisor, primarily doing things both in business and in real estate. And then after the last recession, I got a little bit overly confident, lost it all, basically went over $1 million in debt. So that means the homeless guy on the street was $1 million richer than I was, right? So went broke, didn't file for bankruptcy. I actually avoided bankruptcy, but I did have to pay back a lot of debt, negotiated it, everything I could to get back to zero, and then build my way back to having enough passive income to be, once again, work optional, where you work because you want to, not because you have to, because you have enough passive income to pay all your bills. That happened to me the second time in 2016. So to stay in integrity, of course, I didn't teach people how to get out of the rat race between the Great Recession and 2015, 2016, until I was starting to get out of the rat race again. And that's what I did. Now that's what we teach people to do, is really those people are like the Dave Ramsey poster children, like how to get them out of the rat race, right? Like how to actually do it. And unlike Rich Dad, Poor Dad, who talks about getting out of the rat race, but then you never learn how to actually do it, we actually help people strategize, work with them one-on-one, help them strategize, and then connect them with deals that'll help them get out of the rat race. So essentially they work because they want to, not because they have to. So that's where we are now. Yeah. So
Very
the
exciting.
question is, should I tell anybody about what we do, or which strategies we use, or should we just keep it at that?
Oh, let's get into it. Let's get into it. I mean,
don't leave the people waiting.
Yeah, I mean, yeah, we got to do it for them, because they're the ones who want to know. Us here on this call, I want to know desperately how to do this myself. So please, let's get into it.
Let's get into it.
Well, definitely the first step is screw the stock market. No. If you're going to be in the stock market, I'll tell you this, and this, I can't remember if I shared this in the last episode or not, but one thing that not many people know is that I used to teach people how to trade stocks and options, right? I think I shared that briefly, but out of the 200 people I worked with one-on-one, and I taught them a very low risk strategy, only a handful got better when I wasn't keeping them accountable. So if I kept them accountable, a lot of them were successful, but when I stepped away, and it was just left to their own devices, many of them gave into those devices. Usually it was human emotion, human error. So I'll tell you this, it's not that you can't make money in the stock market, but from my experience, it's been that when people try to trade, the vast majority of them, I would say at least 95%, even after being trained how to invest in the stock market, don't make it work. Where with real estate investing, you can kind of screw up and still somehow make it work. You can still do the tradition. You can be like the old school person who buys the property in your backyard. You probably bought it for too much and still turn it into a rental. You might have made a little bit of cash flow, maybe not much, but thanks to inflation and appreciation, you still end up making money because it just happened. Because real estate has been really one of the safest bets over history, right? The stock market, not so much, especially if you're just talking about the S&P. But when it comes to actually doing something and doing it passively, which is what I teach. I don't teach people to be active investors as much as passive investors. Real estate's one of the best ways to do it. So to stay passive, like many of our clients, because most of our clients, they come to us, they say, I want to be able to be, I'm already busy. I'm working my W-2 job. I'm making great money at, Microsoft or whatever, but I don't know if I'll ever be able to retire. My 401k is not enough. That little stupid match hasn't really done anything. Plus the stock market's bipolar. So I lost half of it last year or the last few years of this recession. So I got to wait another 10 years before it comes back to where it was. All that kind of stuff happens, right? And so a lot of them just say, I might want to keep working, but I just want to have the option to not work. But I'm too busy. Even in business owners, same thing. I love my business. I'm just too busy. I just want the option to break away if I need to, or if something happens in my life, I have the option to step away, not be stuck in a very high paying business that's really like a job for me. So often what we'll look at are these kind of key investments. Number one, turnkey real estate. turnkey real estate is different than buying a real estate property in your backyard. Most people, when they buy it, they're dealing with all the tenants, the toilets, and the trash. They're trying to deal with all the issues. Somebody has a leaky faucet. You got to go, and if you don't fix it, you got to call a contractor to fix it, and then you're spending money on that, and you're probably hardly making any money in the first place on that property because you really don't know how to charge and raise rents and all that kind of stuff. That was me in the last recession, where I was a horrible property manager. Where turnkey real estate, you don't manage the property at all. Somebody else manages the property. They help you find the property in certain markets. So you can buy a property anywhere in the country. Heck, I even have clients in other countries buying the US because, for example, Australia, you can't make a crap, in the real estate there. They got like 3 different types of mortgages you can get. It's not just the first and second. They even have third mortgages, and you got to pay them in certain orders and things like that. So complex that, it's just the prices are too high, rents are too low. It doesn't work. The numbers just don't work out. They look at America and they say, oh my goodness, I can make so much more money here, right? But the cool thing is, even if they're international, they can still buy a property over here, be hands off. They still are calling the shots. They own the property at least. So it's their asset. You have a real tangible asset, but somebody helps you find the property. They get you the financing for the property. If you have to get a mortgage, they, fill it for you. They get the tenant for you. If there's any issues with a stove coil breaking, they deal with it. And then they just take it out of the net rent if they have to fix something, but you're hands off. You're not dealing with all those distractions. Now, I will call it semi-passive. It's probably the least passive of the things that we talk about often. But still, if you spend half hour, 1 hour a month on average having a portfolio of properties, that's pretty dang passive, right? That's not too shabby. So that's one strategy you can use. And even today, even though the numbers aren't great, we're still seeing that there are pockets or certain areas where you can make at least a 10%, what they call a cash on cash return, where that's the actual net profit after paying the property manager, after paying your mortgage payment, and everything else. And that doesn't include the fact that if you have a mortgage, your renters are paying down the mortgage for you. That's not part of that 10% plus return, right? So you're gaining equity even if there's no appreciation because they're paying down your mortgage for you. You get tax benefits where you don't really pay money, you don't pay taxes on that. Very rarely do you pay much, if at all, in taxes because of depreciation. So you're writing off everything, keeping this almost tax-free money, almost like a Roth, but you don't have to wait till you're 59 and a half. And even better is that if there's appreciation, it creates an amplifier effect. Because if you only put 20% down on that property, say that the property is $200,000 and you put down $40,000. Well, if that property appreciates 10%, that's now becomes worth $220,000. Cool. Well, most of the time people just say, oh, that was 10%. Not bad, not too shabby. But it wasn't 10% because you only put down $40,000. You made $20,000 in equity. That's a 50% rate of return. So if you put 20% down, whatever you get in appreciation is a quintuple return, right? It's a 5 times multiplier. So that's why, when I compared my numbers, I bought a rental property about 5 years ago in Memphis, compared that with the S&P 500 in that same period of time, S&P made me about 40% if I had put that same money in there. It went from $32,000 of a down payment, right? If I put that in the market instead, it'd be around $45,000 to $50,000 depending on the day. But that property, I've already between cash flow and appreciation and everything else, I've already made well over $100,000, right? So I've made, and so really, if you look at the numbers, I've made more like a 300 and some odd percent rate of return versus a 40 to 50% rate of return in the stock market. So it's
now I have a quick question about turnkey because I've signed up for a few different turnkey providers, and part of the thing that's held me back from pulling the trigger is that I don't know anything about these local markets, and so they'll send me these little pro formas, right? They'll say, "Oh, you can buy the property for this, you can rent it out for this. These will be your expenses, and here's your profit."
Yep.
And I either have to believe them or do a bunch of research and try to figure out if that's true or not. So far, I haven't pulled the trigger on any of them. Can you tell me a little bit about that due diligence or homework?
Yeah, I have a Ronald Reagan philosophy. It's trust but verify, right? He always said that.
Okay.
Heck, he even got Mikhail Gorbachev to learn it or say it back to him in English, I think. I think he even learned it in Russian too. So I like trust but verify as a good one there because you're right. You don't want to just take their word for it, although there is a certain level of trust. A simple Google search can really, in a few minutes, give you a pretty good idea. And if you don't do it, have them send you the information. So for example, what does employment look like? And you can, again, do a Google search and do the same thing. Look up that town. What's the employment rate? Primarily what I like to look for is I never want a one-horse town. This is why I don't buy in Vegas, because if the whole gambling industry goes kaput, Vegas goes kaput, right? So if there's no hospitality, like 2020 was sucked for Vegas, right? So you want to look for places that have multiple employers. Yeah, because if you have a town where the only employer is like the government, and that may not be horrible, but if that's the only thing, or if it's just this one company, it's just Walmart, like there's that Walmart store and employs half the town, you may not want to be there. So usually you want a place that has more of what they call tertiary type market. It's not like downtown, like you're not buying New York City or LA or San Francisco or Seattle. This is going to be something that's more in the outskirts, somewhere that's more of a medium-sized type town, somewhere where it might have at least 100,000 to maybe 1 million people. And those tend to be safer type communities you can do rentals in. But yeah, that's a good point, because you don't want to just trust them, because naturally their incentive is to sell you the property so they can not just make money on the sale, but then property manage it for you and make money that way too.
Sure. Excellent.
So another one I think is great is also, and this one I'm going to say in general, are funds, right? FUNDS, in case, my pronunciation stinks here. But different types of funds, so things like, some people might have a debt fund. They might have it could be an equity-based fund where they're buying up properties. Often they might be syndications, but there's a difference between funds and syndications. So funds usually mean that there's a portfolio of something. So like, for example, we advertise a group on our podcast that has a minimum investment of $1,000, like very small minimum investment, but they typically pay at least about 10%. Except for last year, where they decided to hold more in reserves, didn't pay out all the profits. They paid 8.5%. Still better than negative 20% in the stock market, right? And but for them, they actually lend out their money to real estate investors that are doing flips and things like that. Because the risk might be if you try to find one person where, and I have friends that do this, where they ask for short-term money, they might need $200,000. Well, if that's a huge percentage of your money, you may not want to put all your eggs in that one person's basket. What if they screw up? What if the property doesn't quite sell the way they think it does, or it becomes more expensive on the repairs and things like that? You take a little bit of risk that way. Yeah, you can make good returns, but you take more risk. Where if you have a whole portfolio of them, say like in this company, they have like 350 different loans, only 3 of which are in default, where they're like 60 days past due. You think about that, like it takes a lot less risk in that scenario. And so they're able to pay more money as a result. So that's like an example of a fund.
And as a quick shameless plug, Alex and I actually are in the process of developing a fund. So anyone who's interested, check out our website, screwthestockmarket.com, or you can email us directly at info@screwthestockmarket.com.
See, I was just setting you guys up. And is yours like more of like real estate based, like equity fund, or what kind of fund is it?
It's going to be, we're trying to be more open-minded about the different types of asset classes, but I think it will be focused on equity, but we are open to different types of real estate or different types of businesses too. For example, we've been invited to like an ATM, to an ATM operator, to multifamily operators, and
venture capital as well.
Right.
Yeah, so we're looking at it.
So you're really looking to diversify it. So essentially you're creating your own version of a mutual fund, even though it's not a mutual fund, right? But you're creating your own version in the alternative asset space, right? And I know I have clients from time to time will say, "Oh, it's so hard for me to pick these individual deals." Like some of these deals might be like a syndication, right? Where it might be an apartment building or a self-storage unit. And yeah, you can invest in those things, but it's a one-off deal. And they're like, well, now I have to piece this together, my whole plan. Or I can just go do the fund. And the fund, of course, is already investing in these different things. And maybe you even negotiate better interest rates than I will, because you can put in more money. So they might give you a better payout. And I still get paid too, but I essentially kind of diversify my money, putting it through you. So, there's that degree of separation from the investment, and sometimes is good. Sometimes it has higher risk, but it also creates that easiness of investing where you don't have to think as much, about where do I put my money? How do I diversify in different stuff? So yeah, exactly. That's kind of the whole purpose of funds, right? And that was actually going to be my next point with funds. Is like there's like debt funds or there's equity type funds, just like that. Or you might have a combination of the two. You might have some things that are debt invested versus equity. And again, you're just kind of diversifying it.
Now for the listeners, can you define the difference between those two? debt and equity funds?
Yeah. So, like a debt fund, usually there's good and bad, right? So the debt fund, if they ever go defunct, usually the first one that gets paid, right? Versus equity investors. But you usually don't get any gains. So for example, I have a friend in New Jersey who has a debt fund. He takes that money, puts it into his fund, and he uses it to buy properties, renovate, beautify some properties in New Jersey. He'll pay a flat 10%, and he'll just pay that, and that's it. Now, I asked him, I said, well, is there any way they can get growth? He's like, heck no. No, I'm keeping all the growth for myself. I'm doing all the work. They just throw money in this thing. I'm doing the work. I'm going to take all the growth. So he's like, I'm just going to pay them their 10%. They better be dang well be happy, and people are. Some people are like, fine, I'm good with that. Just take my money.
Better rate than they can get anywhere else.
Which is a huge attraction to doing anything with these kind of passive investments. Where equity might say, yeah, maybe we'll pay at X%, right? That some syndications will say, here on this fund, we'll pay you 7% minimum or 8%, which is really kind of like your debt payment to you in a way. But if there's any growth, or if there's somebody refinances a property, right, and then they pull cash out, it gets spread out between all the other equity investors. If you sell a property for a gain, you get the upside too. So it's not just like a fixed interest rate; you get some of the upside as well as some like minimum interest rate that you might get. So it's a big difference. And there might even be especially on the equity side, you might even get some tax benefits too. There might be some tax benefits when you initially invest, depending on the kind of investment that you're doing.
Very interesting. So with funds, the way you would describe it is ease of being able to get into deals, mm-hmm. ease also of diversification into many other opportunities instead of having to go one-off on all of these individual syndication deals and having to analyze each one and vet the operator again and over again. Okay, so we got turnkey real estate and funds.
Yep. I might as well just keep going on syndication since we kept talking about it, right? So syndication, kind of similar to what we were talking about, but you might be in one specific property or one specific type of deal. So like I mentioned, if you have self-storage, self-storage is one of those that are making a really good comeback right now. And a lot of people haven't caught on. So it's kind of a good opportunity. But in self-storage, you would go into that specific storage unit. The risk is it's that one unit, right? Versus a fund where you could be in multiple things. But the gain is that, of course, that one unit could end up paying really, really well, especially if they, do what they call underwrite, right? They underwrite the deal, meaning that they do their own due diligence. They plan for stress testing and everything else to make sure that even in bad case scenarios, this is still a profitable venture. You still have something that works. So that's where a syndication comes in. Most of the syndications you'll see, you have to be what's called an accredited investor, meaning you have to have at least $1 million net worth, not including your house equity, or $200,000 a year on your tax return if you're single, $300,000 if you're married, right? So if you don't fit those qualifications, then most of these syndications usually don't matter. But there's a lot of variety in there. This is things that I never even knew existed. Now I knew there's apartment buildings, but I thought you'd have to buy the apartment building yourself. Or the syndication, you pool your money with other investors to buy that big asset. So you can have a percentage ownership in that apartment building or that commercial building. It could be a warehouse. It could be self-storage. It could even be in the oil and gas space. I have a lot of clients that's kind of been their favorite thing over the last year or so is that they can get mineral rights where the oil companies will pay to lease the land. So they're paying you rent like real estate, but they're also paying you royalties from anything they get from oil and natural gas production. So whether it's oil or natural gas, you get paid on all of it. And we've seen some 10 to 20% type of returns, depending on the project that they're doing that people are getting paid on. So there's
and that's not even including the tax benefits from oil and gas.
That's right. Yeah. Depending if it's working interest, as they call it, where you're doing the drilling. Some of these, that one's a little bit riskier when you do working interest, where it's speculative, right? You have to hope things work out. With this particular syndication, it's kind of nice because there is no there's some speculation in that sense, but you get paid pretty much after 6 months. Even if they're not fully drilling and getting a lot done, you still get paid because they're still having to pay you for the land, right? So even before they're producing, they're still having to pay you to use your land that you sold them, or that you're leasing to them. An interesting fact, most big oil companies don't want to own land. They actually just want to lease it, drill the heck out of it, do their business, and get out. That's all they want to do. Or just keep getting out whatever they can get out of it for however long they can get out of it, right? So most of them don't care about buying real estate. They just care about doing their drilling, which is what they do best. So there's a lot of good connections there. Other types of syndications I've seen like, car wash, you guys mentioned like ATM funds and things like that too. That's another type of option of things you see. And some of those business interests will give you some tax benefits, like you mentioned as well, where you might get significant tax benefits. You might get a little bit, but there's definitely some tax benefits that can happen there too. The other thing that I've seen happen as well, other types of investment. So we already mentioned, we've talked about turnkey real estate. We talked about funds. We talked about syndications and varieties of that. I even mentioned short-term lending briefly, where you can loan your money to specific investors to do deals. I just had a client just yesterday. Like they texted me saying, "Hey, we're trying to text your client. We forgot his phone number, but we actually got his money back early, like 3 months early. So we want to let him know." It's like, all right, here's his number. Let him know. I'm sure he'll be happy that he's still getting paid the interest you promised him, but he's getting it back faster, right? Plus the principal back. So you can lend money to people. That was the first thing I learned actually when I broke away from being a financial advisor, was you can become the bank that way, where you can literally lend people money and they'll pay you better interest rates than what the bank will give them, because they want ease of money. They want speed. They want to be able to make money off your money, and they'll pay whatever percent they want. And often you'll see people pay anywhere, from 10, 15 plus percent, depending on the deal and what they're doing with that money. So that's another option. And the last one I'll mention, although there might be more that pop in my head later, but actually there was another one that just popped in my head. Although this one's not very passive. I'll just mention this as a honorable mention, right? It's a not very passive investment, but it can generate additional streams of income. Is you can do it franchising. You can actually get into franchises. The more money you have, the more passive it is, right? There are some franchises you can buy for $50,000 to $100,000, and you have to put a little bit of work into it, but it could really pay off. It could potentially start paying six figures within a few years. Not a bad return on your investment if you think about it. So if you have time, a franchise can be a great opportunity. Even if you only have a little bit of time, if you willing to put more money down, there's some franchises you can start in the first 3 or 4 months putting in 20 hours a week or so. And then after a while, it starts to be more manageable, where you're only working 5 or 10 hours a week, but still getting six-figure type of profits out of it. So,
I'll mention in terms of the franchising from some of our previous episodes, everyone automatically just thinks of food. They think of like McDonald's, they think of Wendy's, they think of all the fast food franchises. And you'd actually be surprised. The real money in franchising are in the non-food sectors,
That's
things
right.
like cleaning services or like roofing companies or like, things that are day-to-day needs that people require on a regular basis. And there we go, non-food franchise. We just
got this book in the mail from one of our past guests.
Yep, I know.
Oh, nice.
John,
okay.
Yeah, nice. But yeah, there's tons more opportunities, and they're cheaper to buy into than the food ones. You don't need to have that multi-million-dollar, net worth to buy into some of these other franchises.
That's right. Most of those type of franchises you mentioned, even like Batteries Plus, those kind of franchises that are popular, it's not uncommon for them to never take a single penny from the company for the first 2 or 3 years, because there is no profit, right? Where in 2020, I remember, of course, we're sitting around at home wondering what we're going to do with our time, right? Instead of watching Netflix, I remember considering maybe I should get a franchise. And so I actually looked into it for myself. I remember I narrowed it down to 4 options, 2 or 3 that I was taken very seriously. One of them was a junk hauler company that one was an existing business. So it was a guy just wanting to get out and already had a manager there. So I didn't have to hire a new manager if I felt he was a good fit. Wow. But it was about an $80,000 price point that I could get in and buy my first vehicles, right? And then from there, I can even buy a fleet of vehicles for junk haulers and keep it building and growing as time went on. The other one that I remember, there was it was actually a gym idea. So you remember how Peloton was becoming popular right then? Well, I'm a marathoner. I'm a runner. So there was this one for actually doing this. None of it existed here in Utah at all, but these very high-tech type of treadmills that you don't get from your normal 24-hour fitness gym. They're all make squeaky sounds when you run on them, right? They were like the high-tech, very scientific type things. So I looked at that, and I even almost bought even a commercial space actually, where you lease it to hairdressers and stuff like that. But after talking to a bunch of hairdressers, I realized I don't want that kind of drama in my life. So I ended up refocusing, just went back to my own business. I said, you know what? I can just expand my own business. And so 2020, that's why I decided to actually start hiring employees, and have, just grow and scale my business instead with Money Ripples.
Yeah, actually, Alex and I also thought about it about a year ago, actually getting into franchise as well. We found one that sounded really interesting. It appealed to our inner nerds. It was a lab, like a science lab franchise, which I've never known that's something you can franchise. We ended up actually going the other route and just focusing on real estate deals that we were looking at the time instead. But it was a viable option for a while.
Yeah. That's the thing. When you start to realize how many options there are, you think, why do I even care about mutual funds in the first place? Right? Why do I even care about what my financial advisor has, which is really just Mexican food, right? They really just offer you the same stuff. It's the same ingredients, but you just repackage it differently and call it by a different name. It's like Mexican food, which I've
always said that.
What's that?
I've always said that because I never know the difference of like which one is an enchilada and which one's a burrito and which one is, because it's the same stuff, just kind of shaped.
They just have a different name. Same ingredients. They just might, make the tortilla flat, and then you call it quesadilla, or if you make it open, it's a taco, or if you fold it, it's a burrito, right? Or a tostada or whatever. Like it's all just how they package it. And financial advisors really, when you look at what they offer, it's mutual funds and insurance. That's it. Even an annuity is the combination of the two sometimes, right? So, you think about it, like that's all they really offer. There's nothing fancy. They just throw different names about, but it's really the same ingredients. Where here, we can actually really be more diversified than just paper assets and do more things. The last one I'll mention, this one actually is my darling, right? So I'll say this is the last and definitely not least, is partnerships. So same thing, you could still be the financer, but what if you had somebody else doing the active investing for you? So I actually have a partnership where they buy and sell raw land, and they turn around, they sell or finance it, meaning really we become the bank. So somebody else buys it from us at a certain price and then pays us monthly payments for X number of months. So for example, I was just looking at this on my portfolio the other day because they're buying up all these things here. And one of the lots was, it was roughly about $7,000, but they turned around and sold it for about $25,000. And the monthly payments are going to be over the next 12 years, and I'm making about $250 a month. So the cool thing is people say, what about the recession? I said, here's the deal. If they can't afford to pay $200, $300 a month, then we just foreclose and we sell it to somebody else who can pay $200 or $300 a month, right? It's not like you're buying an actual house on top of that property. They're just buying lots. And especially nowadays with people being freaked out about the government and, running in toilet paper and egg shortages and everything else, more people want to have their own land just in case they have to homestead, right? So there's lots of things you'd be doing with that. But I mean, we're seeing that, a nice little uptick, especially as we're going to the new year here, where, I mean, I've probably had them invest roughly about $220,000, $225,000 so far because they keep reinvesting our proceeds. But we've got the cash flow in just the last year and a half up to about $7,000 a month. So, I mean, you do the math. I mean, normally I would be thrilled if I invested $225,000. I'd be thrilled if I made about $2,000 a month, right? Here I'm making $7,000 a month doing that partnership. And again, I'm hands off. That's all with, I'm trusting them. There's got to be that relationship of trust, of course. But I mean, it's still been roughly about a 45% or so return on my money.
Amazing.
Not bad. It's not bad.
Amazing.
First, I'd like to take a minute to tell Alex he's a terrible Latino. You can't tell the difference between an enchilada and a chalupa. It's just terrible.
How dare you?
I am. I'll admit it. I can't dance. I'm just all the stereotypes. I am not.
So, I mean, those are kind of things that I use. I mean, that we teach our clients about, and obviously we don't tell them to do everything, right? Because you can get overwhelmed. It's like being at a buffet saying, I don't know if I want Chinese or Mexican or American, that kind of thing. So that's where we try to help narrow down the options based on their goals and what they're trying to fit into. And the cool thing is the strategy that we do with it all is, even though we're not just using this to build up cash, but we'll use infinite banking, which if you've ever heard that mentioned before, there's a lot of infinite bankers out there, but the problem is a lot of those infinite bankers, as good-hearted as they are, they're just insurance salesmen. They're not investors. They don't get it. They'll tell you, like, throw your money into a life insurance policy. If you don't know what it is, it's whole life insurance. You can create a supercharged tax-free savings account inside of life insurance. And so it's not just death insurance. You can actually have this tax-free account growing in there. Well, and it grows by a good, 5-6% a year. So it's not bad considering you're not paying any taxes on it. It's like a Roth IRA because there's no tax on it at all, but there's no 59.5 rule. The problem is most infinite bankers, and they'll tell you to go buy your car with it or buy a house with it. And they'll tell you you can retire with it. It'll be a supplemental retirement income, which is really just financial advising, twisted for insurance agents, right? That's really all it is. But if you do it the right way, and this is something that I've spent years perfecting, if you get it to the point where you can minimize the cost as low as possible so that you have more cash and they're growing, you could access that money in the first year to go and invest. And the cool thing is why you want to invest with using your life insurance. People would think that's crazy. But the reason you want to do that is because you can get a line of credit against it, borrow money from the insurance company so the money's still growing tax-free, while then turn around and investing that cash. So say that you put it into a fund and say that fund pays you 10%, right? Say you borrow $50,000 from it, you have that fund paying you 10%, that's $5,000 a year. You take that $5,000 instead of putting it into your savings account to reinvest later down the road when you have enough to invest again, you take that money instead, pay down the line of credit. It's kind of like what people have done with their HELOCs, right? Especially earlier, not so much lately, but they'll invest with their HELOC, they'll charge it up, their home equity line of credit, they'll charge it up, and then they'll take the cash flow from that investment to pay it down and then charge it up again. Same exact strategy, but the benefit here is that this money pays you money. You still get paid on the full amount of money. So if you borrow that $50,000, but say you had $100,000 in there, guess what? All $100,000 still in there paying you tax-free dividends, more than 0.nothing% like you get at your bank. It's paying you dividends. You use that money to pay it back. When it ends up happening, you make money here and here at the same time. You essentially make money in two places.
You're getting paid twice. Once. Yeah. No, that's the concept that was the craziest for me once Alex and I first started into our financial journey. Mm-hmm. First of all, every person of any type of financial wealth or means, they all tell us they do this.
Yeah.
I mean, it's free money, and it's just blew my mind. I always thought that it was like, okay, this is some hype I see on, TikTok or something. This is not real, but it is. It's free money. You're basically borrowing from yourself on an account that's keeping up with the rate of the S&P 500, but without any of the losses. Right. I mean, imagine if you had a stock account that just keeps going up and never down, and you can borrow against it, make money off that money, and pay off the loan, and still continue to end up with a profit from that loan. And then you don't pay taxes because it's not technically income. It's a loan.
Yeah. Yeah. It's
awesome.
Amazing.
It's genius.
Yeah. And there's a lot of things I've taught about that. Oh, go ahead. Sorry, Alex.
Oh, I was just going to admit that for me, the first time I was exposed to it and someone offered me a whole life insurance program, I just looked at the amount. And I said, I'm not paying that. I could get it for much, much less. I could get it for...
Exactly.
And I didn't see all of these other benefits. And so, I think just to acknowledge that if you've seen it and you got that sticker shock, it is more expensive than, I guess, what we would call term life insurance. And so it's just not an apples to apples comparison. So it is important to kind of be deliberate and understand how you're going to use it and how it can just that you're getting something different for more money.
That's right.
It can potentially pay for itself. I mean, it depends on how entrepreneurial you are and how you apply and leverage that money. But I mean, you can literally make this work for you so that you can create a nice income off of this.
Oh yeah. And that's the thing is that, most, like I said, most of those guys will teach us supplemental retirement. They won't even talk about how to do it with real estate or other alternative investments, which is better than just letting it sit in that account. Because here's where people rip on it, right? And there's actually truth to it. You'll hear Dave Ramsey rip on it all the time, Susie Orman, right? All those people. Heck, even financial advisors. Heck, I ripped on it as a financial advisor. I didn't even know anything about it, but I still ripped on it, And the truth is, like you said, it's expensive up front because unlike term, where term gets more expensive over time, it's cheap up front, but then it gets more expensive to the point where you'll cancel it before you die. And by the way, insurance companies literally bank on that fact. They know that less than 1% of term insurance policies with their companies will ever pay out. So as it's cheap, they make lots of profit. They love promoting term insurance. In fact, guess who taught the whole buy term, invest the difference? It was an insurance company. It was back in the A.L. Williams days from like the 1970s, 1980s. They taught that concept saying, This is awesome. Insurance companies make more money. We can still go and invest the money in the stock market or whatever we want to do. This is perfect, right? They were doing that kind of thing. Mm-hmm. So the whole buy term, invest the difference actually was taught by an insurance company who wanted to make more profits. But the whole life insurance, the bad part of it is, especially if you do the traditional whole life, is that the first 2 years, everything you pay into it goes to insurance costs. And it might be more, like you're saying, like you might be, instead of paying for a few $100 a year for term insurance, you might be paying $10,000, $20,000 a year for whole life. Say, well, man, I just paid the first 2 years. It all went to costs. In a traditional whole life policy, a basic one, you will spend about 15 years before you finally have as much in cash as what you paid into it. So if you can wait about 15 to 17 years, fantastic. Problem is, people are like, I can just go and invest that money and make more. And they're right. So the difference of what we do, and we kind of perfected this in our own company, is that in the first year, instead of 100% going to costs, only about 20% goes to cost. And there's a lot of popular infinite bankers that'll tell you, oh, no, you pay 40% in the first year. That's bull. That just pays them more money. That's the truth. But I even had an infinite banker guy that sold me my first policy that imploded later on. That's why I got so pissed about it. He sold me the policy, and after I knocked down all of his objections, he finally just said, Chris, I just can't afford to cut my commissions. That's why I did it that way. I'm like, well, that's the problem. You're reliant upon the income that you need to sell life insurance. So you're going to not necessarily do what's best for the client because you're trying to make a living. That's why you want to have people that actually have passive streams of income doing this for you. And so instead, I found out later, you only have to pay maybe 20% in cost in that first year, meaning that if you put in $20,000, you still have $16,000 there that you can leverage and use to invest. Now, someone would say, yeah, but I have to pay first. I could just buy a couple $100 term policy and then invest the other $19,000 and change, which is true. But what happens during the third year, it actually pays for itself. It actually has a net gain by that point. So it's only the first 2 years you have costs. Year 3 onward, it makes more money than what you put into it. So it's like what you had just told us earlier, Aziz, like it's paying for itself if it's done right, not the traditional way, but if it's done right by the third year, not by like the 10th year. And then eventually by the 5th year, you have more in cash than what you paid into it. So I always ask people, I'm like, well, yeah, you're right. You're absolutely right. The numbers work out. If you only invest for less than 5 years, buy a term, invest the difference. If you're going to invest for longer than 5 years, which almost any investor would, this is going to save you money. And you're going to make more money, and you get the double dip aspect that you just can't get anywhere. I even ran some numbers. I showed someone who's like doing just like a simple 10% fund, right? And doing that with not even buying term. They didn't even buy term. I just said, you take all your money, invest in that fund versus using life insurance. After 10 years, you still had $10,000 more a year in passive income using life insurance versus just using your savings account.
Very interesting. So that's really exciting. And we've talked about infinite banking on the show in the past. But it's cool to hear your thoughts on it because it's different, right? Like you said, you're talking about it from the perspective of an investor. And again, I think, if there's one really valuable lesson that we've taken from your story, it's put yourself around people who've actually succeeded at doing what you want to do.
Right.
And do what they do. And so that's really key. Now, there's one thing in all of these different things, including infinite banking, that has been a real challenge for me personally as an investor, is the idea of big money, right? Like if you want to get into a fund, I think a lot of them have minimum investments of $50,000, $100,000. I've even seen some that are 200, or I'm sure they go even higher than that. Mm-hmm. But you need kind of a big chunk of money for most of these different things.
Yeah.
But then you start making small chunks of money from cash flow, or from myself in my own personal experience. I'm a realtor, right? So sometimes I'll get a commission. I'll make $10,000. I sold a house and it's a bonus, but that's not enough money for me to go and invest and buy a house.
That's right.
A turnkey home, or to do a fund. What do you recommend for someone who has a smaller amount of money, but still wants to put their money to work, other than just letting it pile up until you eventually, it might take me a year or two to eventually get to that 50,000.
Yeah. I mean, that's one reason why I've had people use infinite banking, just for that reason, right? It's a place they can earn more than 0.0%, and then you get taxed on 0.0% at the bank, So people will do that. But there are other opportunities, of course. I mean, like I know we advertise a fund on our show that has a minimum investment of $1,000, and so there are options. But I would just say this is that don't stress if you don't have at least 50 or $100,000 and you're like, I don't have enough. Your focus should be purely on building that up to at least $100,000 before you even worry about trying to invest in these kind of things. Because do the math. Let's just say you do have $25,000 saved up. Let's just say you make 10%. You made $2,500. Yay. You went from 25,000 to 27,500. That still doesn't get you anywhere close to doing the bigger deals, right? I'm not saying that's bad. I'm just saying that really your focus should be more on your real economic engine, which is your income. How do I increase my income? How do I reduce expenses? How do I have more to put away and build this up as fast as I possibly can? And especially like if you're a realtor, even better, because you have, as a business owner, you have control over some of those things. So you can get those big payouts, build it up. And like I said, you can store it in just a simple checking or savings account, of course, or you can use infinite banking or a combination of the two, which is what I usually recommend, and build up that cash. And then as you get to the 50, 100,000 plus mark, then you can start looking at doing some better deals, So that's kind of my recommendation is until you're hitting at least $100,000, don't stress. Just focus purely on building that up to be into the six figures. And then you'll have options, even if it's like a turnkey property or something, or a different fund that you can invest in. And usually that's what I tell people. If you have less than $250,000, you're probably just going to be looking at doing turnkeys and lower investment type funds. And that's it. Like you probably won't do a syndication. There's not enough money there to diversify properly. Some, partnerships, like the partnership I'm talking about with the raw land, somebody needs at least $300,000 just to do that. So, even short-term lending, most of them require at least $250,000 to buy that property, even if it's at a discount. So really just focus on building up your assets and be grateful for every dollar you save, everything you put away, because take it from a guy who went from a negative $1 million that had to get to zero, then from zero to having more money to do passive investments. It is a long road and it can try your patience, but if you really focus on the month-to-month cash flow, increasing income, managing your expenses, not being dirt cheap, but getting to a point where at least you can be, trim the fat and put away as much as you can. That momentum will pick up, it will increase, and it will go in your favor.
Awesome, very cool.
Yeah.
Well, this has been awesome. Again, just very tangible, so we really covered it all. I mean, between our two episodes, right? We covered mindset, we covered overcoming challenges, we covered getting beat up and getting back up off the ground like Rocky. We covered very tangible, actionable things, as tangible as infinite banking and turnkey and syndications, all these very actionable things. We talked about a bunch of different asset classes. I think this is just a ton of value that you've provided for us, Chris. Thank you so much.
Yeah.
You're a
walking money machine.
I'm
at this
tapped
point.
out. That's it. I have no more knowledge in the universe, so I'm done.
I find that hard to believe.
Yeah, we're just skimming the surface, but it's good stuff, though. I appreciate you guys having me on.
It's very exciting. One more time, I'd like to invite you again to just share how our audience can contact you and connect with your firm and what you do, to learn a little bit more about to going deeper into all of this stuff that we just talked about.
Yeah, I really appreciate that.
Or even how to work with you.
What's that?
Or even how to work with you.
Yeah, I mean, easiest thing is go to moneyripples.com. In fact, we even have a passive income calculator on there that you could figure out how much passive income you could create in the next 12 months. So we have a cool little calculator you can try out there. But yeah, you can do that. You can follow us on YouTube or our podcast, the Money Ripples podcast, and Money Ripples channel. At Money Ripples is our handle for all of our social media. So yeah, easy to find us if you just look up Money Ripples.
Awesome. Okay. Well, again, thank you so much, Chris. Really good to have you on the show again, and we'll welcome you back whenever you decide for part 3.
Sounds great.